Now in this next chart, we are going to look at the 30-year Federal Reserve mortgage rate. Average mortgage rate as reported by the Fed, the St. Louis Federal Reserve. As you can see here on this 10-year chart, from 2013 through 2019, the mortgage rate average was stable in a band between 3.5% and 5%, which is already historically very low. If I go to this max threshold, you can see here that in the 1970s and 80s, the mortgage rate was well into double digits. And even if you exclude this extreme period in the high teens, 10% persisted into 1990, 1991. And that is why home prices have risen so much over this period. People may say that a $100,000 home in 1980 is now $2 million today. But that is not only because of economic growth, that is because of this lowering mortgage rate. Now that is also because of technological deflation, but that has created a lot of other distortions in this market. So back to the 10-year. Because of COVID-19, the Federal Reserve, which does money printing only in the form of buying treasuries and mortgage-backed securities, thereby distorting those two markets, and therefore not allowing quantitative easing to diffuse in a more broad and granular manner, pushed mortgage rates well below 3%. And this is not a linear situation, remember, because as your payments go down, the price of the home rises even more, and the ratio of home price to monthly mortgage payment reaches unprecedented thresholds. And then when the Federal Reserve begins tightening again, we get to these higher rates. This is a tripling of the rate, from a low of 2.7 or thereabouts, and for several months, not for just a single day, to now 7.18%. Many people who bought here will see their home prices fall tremendously. It would have been less of a problem if it went merely from here to here without this low divot in the end, but now this high mortgage rate guarantees a housing bust, because you can't have a rate increase this high. Even if you go back to this 2007 and 8 period, there wasn't a rise this steep, ever. So this presages a housing bust, barring more money printing in a manner that does not cause mortgage rates to fall, which would require a new type of money printing altogether. 7.18%, and as I've said on other videos, the area enclosed by this mortgage rate and some base that you can take 4% as a base, for example, since that was the median in all of the several years before COVID. The more this area increases, the more the cumulative pressure on housing is. And the area increases both as time advances and the mortgage rate is higher. So both contribute to the area enclosed increasing, and therefore the cumulative pressure on a housing bust. So those interested in the housing market need to be checking this data point every week. Thanks for watching.